Michael, we have the rand trading weaker today, back above 740 in fact against the dollar, 741 just a short while ago. We did see a bit of strength coming through yesterday, trading down to 725 after the confirmation that HSBC was talking to Old Mutual and NEDBANK about a proposed deal. But it looks like we're back on the back foot again this morning.
Certainly does, Stephen, and I think until we have some more clarity as to how much HSBC will be offering or any other details, whether or not the deal is highly likely to go ahead or not, I think the market is kind of just waiting to see those developments very closely, and then we'll act accordingly. Having said that, though, I do think that there's been a lot of speculation about a possible buyout of NEDBANK for a number of months now, and I think it's reflective in the NEDBANK price. We've seen it outperforming a lot of the other banks in recent weeks and months. So I think that the market was primed for this, and it wasn't too much of a surprise. And then, of course, the million-dollar question is, if the flows do come in, and how much will they be? Will those flows be sterilized, at least absorbed for reserves by the Reserve Bank, and or will they engage in some kind of an FX swap to carry out the transaction and to pay the NEDBANK shareholders? If that were to be the case, then I think it would be fairly rand neutral. It definitely enhances our balance of payments and sends a very good message from a sentiment perspective that foreigners are looking to invest in South Africa. But in terms of the actual influence on the spot rand market, I think it's going to be probably less than what a lot of people are hoping for.
Well, at the same time, we have the euro trading at a 6-week low against the dollar, about 126.5 at this stage. We've also had a growing strike action in South Africa. So while we've seen the auto strike end and the Implat strike end, this public sector strike seems to be ongoing, and by many accounts it looks like it could last for quite some time. Do you think it's a mixture of local and international factors that are seeing the rand weakening?
I do indeed, Stephen. I think that we've seen the rand tracking that euro dollar pretty closely, especially over the last few months. And we've seen the dollar now clawing its way back against the euro, and the dollar is once again benefiting from its safe haven play. We spoke about it over the past couple of weeks, that we thought that the dollar was going to ironically benefit from global growth concerns, even if those global growth concerns were stemming from the States. And we've seen that dollar indeed coming back on its safe haven sort of attributes, and the rand is also falling victim to these global growth concerns, and risky assets aren't doing that well. We've seen Asian markets come off this morning. The Nikkei, as an example, is down over 20% since April of this year, so that implies a bear market has developed within Japan's kind of leading stock market. So it doesn't make for good reading. There's a lot of lingering concerns out there, and emerging markets are coming off the boil. They've run hard, and we're seeing a bit of profit taking now.
Just looking ahead, we have a whole raft of economic data coming out over the next couple of weeks, starting today with the second quarter GDP reading. Of course, we've got CPI and PPI tomorrow, and of course this all leads up to the Reserve Bank's MPC, which I think is on the 8th and the 9th of September. What are you expecting from all of this?
Well, basically on the GDP front, we softer than market consensus. The market's expecting GDP to decline from 4.6 in the first quarter to 3.8% quarter on quarter, and that's the seasonally adjusted rate. We're expecting it to drop all the way down to 3.1%. The mining and the manufacturing sectors are likely to come under particular pressure as a result of this strong rand environment. The World Cup effect probably only coming through slightly. We might see more of the positive spend coming through in the Q3 reading. So we're a bit softer than the market expects, and we're also expecting a fairly benign inflation print tomorrow at the CPI level. So I think it all augurs well for keeping alive those interest rate cut expectations. The market is pricing in around about a 60% probability of an interest rate cut at the next meeting, and funnily enough an 80% probability of an interest rate cut at the November meeting. So the market is still priming itself for another interest rate cut. We don't share that view, especially with these ongoing strikes that we're talking about. Yeah, we don't think the Reserve Bank is going to cut by 50 basis points, but the market does believe there's still that outside chance of one more 50 basis point cut from the Reserve Bank.